Are central bankers around the world about to pump markets back up? Hello, ladies and gentlemen, and welcome back to a special weekend edition of the Markets Around the World. We'll be talking about stocks, commodities, and cryptos, and we're seeing some interesting breakouts on some of those markets. But more importantly, we have a massive injection. Credit Suisse seems to be saved, and regional banks in America are backstopped for now. But what does that do for stocks moving forward? Well, we suspected that we would hit this very important level, which we did in the futures market, and now we're selling back off to a key zone where I believe buyers may sit. Let's take a look at all of the hottest markets for the week ahead. There's a lot to discuss. So welcome back, everyone, to the Daily Show here. We'll be talking about the latest news, macro data, lead indicators, and the hottest charts. If it's your first time here, remember to subscribe and smash that like button. But let's get into it straight away by discussing central bankers' moves. First up, we'll talk about UBS, though, coming out with regulators to potentially save and do a Credit Suisse takeover. That's definitely the big story of the weekend. But what will it really do to markets? We'll talk about that later on. I also want to mention that there's been a few stories coming out about analysis of SVB showing that there are over 180 US banks that might still collapse. For now, the central bankers are creating massive, and I mean massive, liquidity backstops against this. Here, in fact, is the Fed balance sheet recently, and you can see what's happened to the Fed balance sheet. Now, notoriously, when the Fed balance sheet goes this way, we generally see markets start to pump. And that's why we've seen the reaction that we have in the technology sector over the last week. Liquidity was starting to improve, as I mentioned, from the central bankers. And I actually went and posted over on our Twitter, follow at FX Evolution, links in the description if you're interested, that we have seen a significant shift here in liquidity. This was the liquidity shift that we saw back in late December into January. And this is the liquidity shift that we've seen during the mid-March crisis injection. This is a big deal because whenever we've had these massive liquidity injections, the markets have tended to go on. Remember, we're meant to be in a tapering market where the central banks are reducing liquidity, but what they're doing is they're raising rates while also injecting liquidity into the markets. And that's sending mixed signals to the market themselves. This brings us to the discussion of how high are we going with central bankers? And more importantly, as we head into this week, the biggest week, of course, with a new rate rise kind of expected on the markets, will we even get one? Well, this is where it gets a little bit different. Here's our future projection of what's going to happen to yields over the next 12 to 24 months. And you'll notice there's a big shift of heaps and heaps and heaps and heaps of cuts now coming through into 2025. Central bankers are expected, according to the bonds market, to protect the economy at all costs. Look at the difference here. Over here, we have March the 8th. Look where we were, 5.75 to even 6% potential. Now we're down to, this is it. We're going to pivot and we'll need to cut because we broke the system. Remember, every time central bankers do this, they tend to break the system. What about sentiment? Well, sentiment turned incredibly bearish last week. You can see one of the surveys here, which we often use as a bit of a counter idea, really came in bad. And it came in super bullish only a few weeks ago. In fact, as of the February 15th kind of reading, we saw that there was more bulls than bears in the market. Now that's changed in only 1 month, or literally almost less than 1 month, to way more bears than bulls. So with Fed liquidity coming back into the system, everyone turning bearish again, does this mean that the market should be rallied? Well, we've got some key news on that a little bit later on. I also think that this is where the Fed's credibility comes in. The Federal Reserve should and may have to raise 25 basis points. Remember that they've said that they're doing anything and whatever it takes to stop inflation. If they now pause the interest rates after basically saying they were going to do at least 25 basis points, that kind of ruins their credibility. Here we see the other previous times when Feds have, or Federal Reserve and other central banks have tightened, and they always tend to break something. We've reported on that. This time they're so far, as we know it, broken only one thing, which is, of course, the banks, especially the regional banks, and the banking system is churning. Now, this is not the first time it's ever happened. Every Fed hiking cycle tends to do this, and it usually ends in a recession or a financial crisis. Again, this chart here shows you when the Fed has hiked and what ends up happening afterwards. What's important though, that there were two types of bank failures here, and it didn't lead straight into a recession, which is interesting, though they were different times with different bond readings. So I think that's important to note. Also, the question comes in whether we've hit a low in the markets. And this comes back to what sectors are doing well over the last 3 months and what are doing poorly. Generally, what leads us out of recession is technology, communication services, consumer discretionary, those types of markets down here. What tends to lead us into the bottom of markets, though, in terms of outperformance, usually is staples, utilities, and healthcare. Now, I've been mentioning a lot about utilities, but that's separate to this particular report. But what generally happens is when we're bottoming, these three do well. Now, you could argue, though, that these did okay last year in 2022. So if you're a believer in a new bull market, you could argue that utilities, consumer staples, and healthcare outperformed in the back end quarter of 2022. And now in the first quarter of 2023, we're seeing an outperformance of the right sectors: consumer discretionary, services, and information technology. Remember, we use XLY versus XLP as a good reader of this, and we'll put that on a chart a little bit later on. So the markets have been following the no recession path. This basically means that the markets have disagreed with the bonds market, and where we find ourselves right now is basically here. Now, in every single time that we've ever seen a recession, we've always got a new low after this point. Will that come now? Well, you would think that these central banks kind of coming out and backstopping the financial sector so fast is probably not going to cause us to go down there just yet. If it becomes toxic and starts spreading and they can't hold it, of course, then we'll be down there. But I'd expect it to be more of a fight between the Federal Reserve trying to stop inflation and the central bank, or the bankers of the world, and all of the big kind of, big investors saying, well, we expect rate cuts right now. We need support now. And I think it's going to be like a hissy fit market where the market goes, we need the Fed to cut rates. And the Fed says, no, we've got to deal with inflation, and kind of like a battle between the Fed and the market. Will they finally stand up to the market? We'll find out. Forward EPS growth. This has turned negative recently. As we know, we go into kangaroo or downward markets over this period of time. So even if we do get rallies here, thanks to the initial injection of liquidity, we'll have to watch what happens to that injection of liquidity over the next coming weeks and months. If it starts to drop back off, it really allows the markets to go back down. We also know that there's no real equity risk being put into anything to do with the stocks right now, hence why they're so high. So if we do get a recession, this tends to always come through. Morgan Stanley's Mike Wilson spoke about that, and I think it's a pretty important point. So we know when the Fed pivots, that's not usually a good thing. Will the Fed pivot this coming week? I doubt it. They should go 25 basis points. Will they? Well, time will tell. But according to basically most of the trackers, you're seeing the probabilities of around 60% they do go, and then 40% they don't go, or it's even sometimes 50-50. So when the Fed does pivot, why do stocks crash more? Well, generally it means that we're in a recession or they broke the system. This time around could be a little bit different. Some people say, well, how could it be? But I don't expect still these big drop ones. I think it's more in the vicinity of these types of 15, 20% down. 3,200, 3,000 on the SPY is probably about as good as you could get in terms of the bear side. At least that's my opinion. And I remain optimistic on the US economy moving forward until they eventually break it. Because remember, the system is broken. They will constantly come in. They will stopgap any problem until they can't do it anymore. And when they can't do it anymore, when usually it's something in toxic debt, similar to the global financial crisis, that's when it all goes bad. And unfortunately, at that point, could be a great recession. Let's talk about actual rotations in the market, though. What performed well over the last 5 days and what performed well on a single day kind of market? Well, we can see here that on the Friday trade, it was banks giving up a lot of their gains after doing their first dead cat bounce kind of run. And remember, banks might be getting liquidity and being shored up, but that's bad for the banking stocks because what's coming? Regulation. Never forget that regulation is coming, which is why buying dips on banks at the moment is a dangerous play because regulation is going to smash earnings, and it's actually a better time for bank bonds. And I think a few people understand that kind of concept. Let's move over to what's happening though. Technology, semiconductors, thanks to lower yields, did really well, and gold absolutely flew. And yes, I did say that gold I thought might just hover for a little bit, but I've always mentioned this. If yields are going down, gold is going to get skyrocketed. And that's exactly what happened on the Friday. Another day down on yields, gold broke out high, and it was just running and running and running. And I remain very bullish on gold over the let's say long term here over the next 3 to 5 years. And I'm looking for that 3,000. Why? Because I think it's been suppressed for a long, long time. And when you cut yields like they're going to, that will most likely be very, very good for gold and bad for the US dollar as well. So the combo should look pretty good. Utilities is still one of the best performers over the last 5 days. Communications, semiconductors, technology doing well thanks to all of the perceived rate cuts that are coming. Remember, they are perceived. It doesn't mean that they're coming. It just means that they're meant to come. So just before we jump into the hottest charts that you need to be looking at this week, I'd like to say a big thank you to the sponsor of today's video, which is Tiger Brokers. Now, this is something near and dear to my heart. If you've been watching this channel for a while, you would know that timing is everything, but also stock selection is everything. Well, the great thing is Tiger Brokers have improved their platform now to not only offer many countries around the world in terms of opportunities and trade opportunities there, but also to select the ETF concepts that you're interested in. You can see here, they've got selections now where if you want to trade bonds, here are all of the different bond ETFs provided on the market. You can select 20-day performance charts. You can scale it really any way you feel like doing it. You can also select something else that I really like, which is going down into individual sectors. If you believe that something like biotechnology might outperform in the future, you can bring up every one of the major biotechnology stocks with a click of a button and scroll through them. Being able to do this speeds up your time. It's in one platform and it's available to you right now. So if you're interested in checking out Tiger Brokers and some of the other special offers that they offer community members here at FX Evolution, look at the description down below. And also if you're from Australia and New Zealand, check out the description as well because there's hot offers. And especially for Australian audience, I managed to secure you an additional $30 worth of Tesla fractional shares when you fund with as little as 1 cent. So what are you waiting for? Check them out. Let's get into it. Let's jump into the charts right now and look at the VIX. So we'll get into that. The volatility index jumped to 30 quite a few times. So this is basically where we see the market at the moment not be able to crack ahead. If it does and it closes above 30, then we should be able to ride at least up into 35, if not the magical 40 plus. I'm really looking for a 40 plus read on the VIX to show us that a low is truly in on the markets. Traditionally, VIXs have always gone 40 plus during proper sell-offs, and that's usually marked those bottoms. If you take a look here at 2018 in February, we got that massive bottom. We got a 36 admittedly in December of 18, which was actually quite a big sell-off in markets as we saw compression in technology stocks. So I really would like to see one of these big 40s though. That's usually marked a lot of the bad bear run kind of ends. And you can see back in history, we get it quite regularly throughout time, but this time, not yet. And maybe it's not to come. We'll find out. US 2-year dropped again. All these yields dropping in terms of the market is now saying you need to rate cut and you need to rate cut quickly. This is where gold did well. US 2-year, US 10-year going down to 3.4. We haven't got a new low, but I would mark this on your charts coming into this week. So that's the 3.322 on the US 10-year read. I believe this is what's going to be under, let's say, pressure coming into the Fed's rate hike meeting. And although the Fed is expected to, well, I think at this stage, raise 25 basis points by unanimous decision, if they choose to pause and potentially pivot, the market will like that very much. If they choose to say, we're going to do whatever it takes, we're going to fight inflation, the market could crack a hissy fit. And that's what you're going to be looking for. We saw those forward yields really push out. If I take a look here at December of 2023, you'll notice now we're starting to get into the 3.8 read. So we're way higher than that. So many rate cuts expected by the markets. I don't know if they're going to get them. If I was the Fed, I probably wouldn't do it. I'd stick the course and make sure the economy's back in line. But hey, we live in an instant gratification kind of society. So some of you will agree with me, some won't. Let me know what your thoughts are down in the comments down below. It's always interesting to see what you guys think. HYG, this is the high yield junk debt bonds. So basically it's not usually where you want to be if the markets are going poorly. It's closed its week at a high-low long leg doji. So clearly indecision here. The markets aren't sure whether they want to go lower. They're also not even sure whether these bonds have been protected yet because they didn't exactly fly, did they? Treasuries did quite well. We expect this to continue to be one of the most traded kind of areas. You can see the volume just going out of control over the last week as people started buying and selling them. And if we see US 10-year break through that 3.32, I expect treasuries getting through this high. Super critical zone 109.58. I want treasuries through that zone, and then we can move to the next equilibrium level, which should be up here. So we probably expect yields to get really wild, potentially gold to go absolutely nuts. So many things could come through if this week US 10-year ends up breaking a new low and holding and sticking with it. So Treasury is still doing well, as we expected. We've reported on that many, many times. Move over to copper. Dr. Copper in the economy closed the week low. That's weak for the economies around the world. I expect copper, well, yes, it may have picks up. I'd like to see it back down at 3.7 for copper, where it's going to find some demand. And if it keeps falling off and the market keeps going up, usually that means we need a very heavy supporting arm from the Fed. And if they don't get it, bad things. Remember, copper down, markets up, no Fed support. That doesn't usually end very well. US dollar hated the yields coming back down. Makes sense. You wouldn't want to hold dollars as much anymore. You'd want to hold things like gold and other asset classes such as treasuries. So in this case, what did we get here? Dollar fell off and it came back down to these lows. It went underneath this level. This is actually where I thought buyers would recommence. So I thought you'd get some buyers down in here. And then we went to a new low. If you're a bull on the dollar, I put this orange line here. I really believe if that gets broken this week up, so we get go up and we close above there, 103.96, basically 104, I believe that's a very bullish sign for the DXY, and I still think that's very possible. Of course, into the Fed meeting, we'll find out what happens. Let's look at the weekly here, another bearish close after rallying. The data does not present well for the DXY at the moment. I put this in about a week and a bit ago where I said all the rallies after this big sell-off that we've seen, all the rallies generally have been met by dumps. So that's usually the kind of way we're looking at it. Remember, it all started over here when dollar was the best thing in the world. Then it wasn't. Then we've got kind of like that bounce into a very critical zone. And at the moment, we've got a trend switch towards the downside. So on the small time frames, we've got some key bull levels. On the high time frames, look, it hit one of our key supplies and it's selling off. It needs to do this to find buyers again. If it doesn't, back down we go, and we probably keep dropping for the DX for the time being. Let's move over to gold. Yeah, this was an absolute blitzer. I mean, it flew and it closed right on its highs. That's usually a really good sign for the week ahead. You don't tend to see markets close on their highs and not have a little bit more of buy the dip philosophy coming through. So into the central bank meetings, could it be something like this? Could we finally see gold break that 2100 zone? Wow, could be massive. So yeah, gold on a flyer. You want to see yields dropping or stabilizing, ideally dropping more. If they do, yeah, I think gold's on fire at the moment, but it will become a crowded trade now. So everyone will be talking about it. This is a big breakout, but it hit my weekly level. And I do feel like there's a little bit of resistance here. So I'd like to kind of see this play out probably as the more likely. Previous resistance becomes support. And yeah, if you've held your game, if you've got that medium term kind of concept on gold, well done to you. Natural gas, how's it looking? It's hovering around the zone. It's still sitting here. So natural gas, I believe, was in accumulation now. We'll keep following it, but it's not as exciting as it was a few weeks ago. So yeah, we'll just keep following the switch. And at this point, this is kind of like that semi-buy zone that people have put down. Let's have a look at US oil now. Now, it hates the old yield. It actually closed on a super critical zone. So I really like this previous demand zone through here. So it closed here. Will it actually find some buyers? I'm very interested in the small time frame structure this week on oil. I think oil is going to be very paramount. If you want to know where it kind of switches to the buy side, I believe 69.57 at this stage. If we do move up through that, I think you'll see some nice little rallies on it. Yields, yields, yields. If yields keep dropping, oil probably comes down further and starts accumulating. If yields start going up, though, get ready for a bit of a switch on oil for the time being. Tesla, pretty good last week in terms of it came back to this level here, sold directly off it, which is the previous supports became resistance. And now we most likely await, you would have to think the Federal Reserve, really. I mean, the Federal Reserve's rate hike is going to probably put either the fire under this thing to absolutely blitz or for it to come back down. Now, I've been on the record quite a lot talking about 146. Remember, I spoke a lot about this being weak up here. And the reason was I believed it was distribution. We've now picked back up off our first demand zone. So that was very sweet. Nice. We've moved to here. Nice. So the bear kind of case is still working out here for Tesla. We need a new low. So mark in some levels like this one. I think 176.20 will be key. So 176.20 I'd put on the charts. And if we do end up going high, low, higher, high, lower, low, I feel like that's probably a shift towards potentially further weakness. A lot of it's got to do with the S&P 500 analysis we'll bring in very, very soon. Options week ahead. So the 24th, is there anything here? Just still lots of 200 calls left over. Last week, I've got to say, the market makers did an amazing job to pull it back to max pain across the board of most stocks. They really did well. They made a lot of money. You can say they made a lot of money. This week ahead, though, you just have to think 200's a bit of a blocker, and that's about it. 150 being the put blocker, which makes sense. 150 is the gap close. 200's obviously that big strike zone. What about Apple? Really like the zone it's coming up to. I want to know what is the reaction in this red box. Weekly did not close above these previous highs, so it hasn't shown us that it really has bullish intentions yet. If it does rally, you could expect some sell-offs here in Apple. So again, getting near critical. If it breaks past this, Apple will probably fly, move all the way back to like 170. And the markets will be on a heater. NVIDIA also hit a critical zone, filled the gap. These are the expected weekly options highs and lows. If we have a look over here, you can see it filled that gap and then sold a bit. Anyone that sold in there, I don't blame them. But you're trying to stop the freight train at the moment. We've said before, even though I was looking for shorts here, we couldn't find it. If we did get one, I would have done it. Did I see it? Unfortunately, no. This is one of the best stocks in the market, and you can't fight it when it's on the AI train. What about one of our favorite sectors right now, utilities? Well, it fared pretty well. Weekly looks really strong, closed above the previous week. Nice engulf there. Still looks really good, so can't hate on utilities at this stage. What about the German markets and the international markets? These look a lot worse. So the German market closed below the low on the weekly, and I think it's coming to 14,000. So at the moment, I feel like we could have a disconnect between the markets. Possibly it's a total disconnect. We'll find out. But yeah, this seems like it's going towards 14,000 at this point in terms of the DAX. We'll find out whether it can do it. XJO holding its own. This is the Australian market. You can see it's holding that level that we liked last week. If it does lose this level, though, we probably keep coming down to 6,700 being the next level. So this is, remember, energy, materials, and banks. So if yields do end up keep dropping because the Fed pivots and complains and says, oh, yes, we'll listen to you, don't worry, market, not great for this market here. So just remember, this is a central bank situation going on with the ASX market and also, I think, the FTSE. So both of those markets are going to be tough. Big closure here on the US 2000. So the Russell is showing weakness. Now, I did mention that if the Russell breaks underneath 1700, that is a big zone, because if that occurs, it could point towards front running the SP 500. Remember, the S&P 500, the US 100, they tend to do way better than the Russell at the beginning because people go into the safe havens. And if the Russell and the smaller caps start showing the canary in the coal mine, then bad things do happen to markets. So yeah, very important pivotal week. It did close underneath. I'm not sure I'm super negative on this yet, but yeah, we have to watch it closely. And in the US live stream, which we'll be doing on the Monday, remember there's a competition down below as well. We'll be launching on the 20th, so make sure to check out that. This will be one of the markets that I think we'll need to look for the close. Let's have a look at the US 100. Daily here was a high, low, long leg doji, and it actually filled a gap, which was pretty impressive on the Qs. So this is a gap that we had left over from quite a while ago. If we go to the Qs now and actually put up a monthly, I'll just show you here the monthly. So the monthly was a massive rejection candle in the previous month. There it is, big shooting star. This was the gap that was left behind and actually tapped it perfectly. So that's why we left it on that chart. Bang, hit straight into it, went down. This is the new weekly expected options highs and lows. I don't know why they're that short, but yeah, basically it's not expecting much. I expect a lot more volatility than that. So we'll find out whether it does occur. SPY, here are the zones again. Let's move over to the SPX though. And this is where it gets interesting. Did we hit 39.75? Yes, the futures market did, which we'll look at very soon. So critical level, you'll see how good the community got it. Congrats, guys. You did very well. Well done there. It was a pretty sweet zone. It absolutely tapped it and just got bloop, straight down. Now, where do we expect? We do expect it to probably drop a bit more, ideally, and then possibly move into the bullish side. Now, we do have some good things for the market. Basically, it's just central banks. Central bank liquidity is back in the system. So that's the good things for the market. What else is good? Not much. I mean, maybe lowering rates, but yeah, central banks. But this is a very powerful concept. So central banks are looking good. We saw a breakout of the previous high. It went back to this zone, which we expected bears to fight it out with. And the bulls, I think, are sitting at a very key level. So let's have a look at that key level. I put it here down at around 38, kind of 67. I feel like this level is fairly stacked. It's got a decent amount of confluence. You can see here the 39.75 zone. Look at this. Bam. Just like it just nailed it. And if you go back and watch our other videos, you'll see absolutely nailed it to the T and fully flogged off, which is expected. The way it moved, high, low, high, high, and then just switched down is also fairly correct. I'd like to see it drop a bit more, come down, test this previous demand that sits in here, test a whole bunch of confluence that sits in here, and then find the buyers. So if the buyers are going to commit here, very important. If the sellers get it through though, and we get a new daily low underneath, watch out, because that means that the market's turned sick and it's not really loving what it hears or what it sees at the moment. So daily close will be very important through the Monday and the Tuesday events. I'm looking to see whether the daily gets underneath these wicks or around these wicks. If it does, then I think we kind of move back down to 37.57. And if we get underneath 37.57 for any reason in the future, my next call would be 35.90.80. So 35.90.80 and yeah, all critical, as you know, at that point. But for now, I kind of remain, I would say, cautiously optimistic based on the price action of the last week. We had a drop and a base and a drop, and then it rallied through that to sell off a zone that we believed would happen based on supply and some other reasons. Then we're moving down here. Buyers should be here. If buyers move in, then we should be going for a little bit of a rally based mostly on central bank liquidity coming back into the system. But if the bears get control and push underneath, then we have to reassess 37.50 and 35.80.90. So all critical zones. For the expiration, I mean, it was max pain fest. They ate lobsters and crayfish and everything on our money last week, guys. They smashed us in max pain. So they managed to get exactly or pretty much exactly on the max pain level. So that's why you watch your third week OPEX. I didn't think they'd get it through last week because I thought maybe we'd get some less, like maybe slower central bank intervention. But look, you can't bet against these banks. They panic and they just come out and make knee-jerk reactions and instantly cover everything nowadays. It's a weird world we live in. So 1 million put call ratio in terms of the amount of open options this week. Not very much in comparison to what we've usually seen. 380, and then we've got the 390 kind of zone. So yeah, anything in particular, still a bit of puts in the system, but I don't think it's that notable compared to the previous week. Now, where's everyone getting hyped? It's got to be crypto. I mean, that's a big breakout. 25,200 is closed. You know, I've said a few times that I thought that if this market got through here, which it certainly has now, that we would move towards 30,200. Could it be front running the stock market? You know, some people think that crypto does do that. I just tend to think it's doing its own kind of dance. But yeah, this level over here, big zone. I feel like there's bears there for sure. But anyway, 30,200 crypto's gotten through. Hopefully it pushes up. And if you're on the train, then good luck. If you're not, oh well, doesn't matter. There's always another opportunity, yeah? Let's move over to the news. This is where everyone's talking. FOMC statement, funds rate, projections, press conference. Generally, what happens here often gets reversed here in the press conference. It's going to be a big one. Expectations, 25 basis point hike. I tend to agree with that. Otherwise, you're crappy as a central bank and you break my trust. So you probably break most other people's trust. That we've then got other central banks around the world coming out with all of their information, seeing what they've got to do. And then we go into flash services PMI, 9:45 New York time on the Friday. If you enjoyed today's video, remember to subscribe, smash that like button. Of course, follow us on the socials here. And also remember, check out the sponsor of today's video, which is Tiger Brokers. Links in the description down below. Thanks so much for watching. You have a great weekend. And this is a big week ahead. Bye for now.